Hey guys, my name is Henry. Have you ever looked at a multifamily building with multiple units and wondered how to even begin to analyze the investment? In this video, we will show you how to build a dynamic financial model for a 6-unit building and be able to analyze it like a professional investor. After you build this, you will be able to plug in your own numbers with the buildings that you find and determine key metrics such as net operating income, cash on cash returns, returns of investment, debt service coverage ratio, and even determine the value of the building with the capitalization rate using this financial method. You can even develop scenarios or stress test the financials of the building by tweaking parts of the model and see, for example, how a down payment change or interest rate change or even a vacancy rate change alters your cash flows and returns because everything is connected and dynamic. So you change one number and the whole model changes. So grab a laptop, pull up Excel, and let's get ready to learn. Hey guys, okay, so let's get started. I put some basic information up here, and the first thing we're going to do is build out the rent roll, okay? So let's give that a title, and we're going to populate some fields based off the lease information that we get. And with these fields, we're going to get some summary statistics so we can build some metrics and monitor performance, and also compare against industry standards, industry baselines as well. This is the down and dirty of knowing your numbers. So I have two fields for rent, and I'll get into that in a second. So unit number 1, 2, 3, 4, 5, 6. We're going to do 6 for this. So 2 bed, 2 bath, and we'll say 1,100 square feet. The current rent is $1,200, but after some research, you realize that the market rent is $1,300. And we'll get into why we track that as well when we do some financial modeling. We're going to make a table, and we hit Control T. And your table has headers, yes, these are the headers, the fields. And the reason we do this is because the table will expand every time we hit tab. So I just hit tab. So let's add in some more rents. We'll say that this one is 1250 and still market rent is 1300. As you add a tab, it keeps putting another line below it. So let me copy and paste the rent roll information in here so we're save some time. And so we have some 2 bed, 2 baths and some 1 bed, 1 bath. The smaller square feet have smaller rents, and everything seems to be below market rent right now. So there's a possibility to make some money by bringing these up, and we'll get into that. Okay. So now we want to make some metrics to get a sense of our rent roll. Okay. So units, rentable square feet, average rent, the max rent you are making, the minimum rent, and how much rent total you are getting every month, how much rent you can get every month if everything was at market rate, income per square feet, in the percentage rent if you're above or below market. We'll just do that. Okay, so let's get into this. First, the units. We will just do a max function. It'll give us the max number and the unit numbers because that's assuming that you will be going in ordinal order, going, ascending, so it'll return the max number. So let's do max in the unit column. And as this rent roll grows, that number will change. See? We put in a 7. Let's leave that at 6. Okay, rentable square feet. So the rentable square feet is the sum of all the square feet in the table. This is table 3. Your table might be different. Put it in brackets, square feet, close the bracket, parentheses. You have 5,700 rentable square feet, okay? Average. So now we're going to mess with the rents and look at the average rents. So with that, you hit average right here, and then you hit table, and we're going to take the average current rent. $1,100 is the average current rent. Now let's do the max. Since we have this here, we can just copy this down, mess over here, and just hit max. This will give you the max rent, which is $1,250. Okay, that's right. Now the minimum rent. You just change max, change that to minimum. That gives you the minimum number in that table. So the 950. And that sounds about right because it's unit 4 and all that. Gross scheduled income. Here we go. So that's current. So we are just going to take the sum of the entire current table column. We have $6,600. And let's do the market. Okay, so let's copy that down, and we just change this part to market. And now it's going to give us the sum of this column here, 7050. Now let's see what the current income per square feet is. And that's easy. That's the gross scheduled income divided by the square feet. So you make about $1.17 per square feet when you round up. Now we're going to see what percentage above or below market rate we are. So the way we do this is we take the current gross scheduled divided by the market. We know this is going to be a negative because we know we're under market rent. So we're under market by 5.86%. So that's how much we have to come up to go get to market, okay? So let's do some market metrics. Capitalization rate. You should know what that is. If you don't, I'll make a video on that as well. And we'll put that as 7%. And we're going to make this blue so that people know that it's editable in the Excel file. Everything else, this is all driven off the table, okay? And then the whole table is editable. So we won't make it all blue. So all this in black shouldn't be touched because it's all driven off these numbers over here. Capitalization rate is based off your research, based on the local market, as is the vacancy rate, which we will put at 5%. Okay? Now we're going to build out some loan information. So rate, term in years, closing costs, loan to value, down payment, loan amount, monthly mortgage, your monthly mortgage payments, your annual debt service, which is basically that multiplied by 12, which is something you need to know, and your cash due at closing. Some of these we're going to have to return to build out. Okay, so we'll put this at 5% for example. The term, 30 years. Closing costs, we'll put 1.5% of the loan. Of the list price. And we'll say loan to value 75%. That means that the loan is going to be 75% of the entire list price or purchase price, meaning that 25% will be your down payment. And these are numbers that you put in yourself. We're going to get back to these soon. We have to build out a few other things before we come back. But let's just build out the skeleton here. So the property value as well, we're going to have to get based off the income, the net operating income, debt service coverage ratio, DSCR, very important to know. And that's going to be driven as well by formula and some ratios to make sure you're within standard and to track progress over time as well. And return of investment, also known as an ROI or on cash return. Okay? And if we hit Alt HOI, Alt HOI, it's going to space it so everything fits. So let's make this look a little bit better. Before we leave it, we're going to add some heavy borders. And then let's make the top a little darker to differentiate it from the rest. There we go. Let's see what it looks like. Alright, so that's going to give us some interesting information. Build out the actual annual property operating data. Okay, and this is just the P&L statement pretty much. So you have your income. Gross scheduled income. This is going to be annually. Other income, if you have other sources such as coin laundry. Total gross income. And vacancy credit loss. And we put that credit or vacancy rate down there. Let's build out this box now. So let's put a little box around it sooner than later. Pretty it up. Okay, so now what we're going to do is this thing called data validation. Okay, because we're going to toggle between two scenarios. And the way we do this is we go to data, we go over here to data validation, and then we're going to input a list. And the list is going to be in the source, these two right here, rent current and rent market. So when you hit that, it gives you an option, okay? So let's hit Alt HOI again to expand this so it fits. So the option is going to be done this way with logic. So if rent current equals, we'll put rent current, we're going to return current gross scheduled income times 12 because we want it yearly. This is annually. So if false, if it's not rent current, if it's anything else, it's going to be market times 12. Okay? So let's test that out. So this should be the current rent, current gross scheduled income, this number here, times 12. All right, that looks right. Now, let's see. I copied and pasted this down. Let's see if it's correct. Okay, looks good. So now you can toggle between different scenarios if you were to bring it to market rent or not. Other income, this is, you can put this information yourself. So we'll make it blue. Let's say $6,000 a year from coin laundry. And then we do the total. And there's a cool shortcut for this actually. It's Alt plus. So Alt plus adds the nearest cells together. And you hit enter, and there you go. That's your gross income. So let's put this back to current so we don't mess around too much. And I like to do percentages to figure out what percentage of the total. So it would be the number divided by the total. We'll fix it by hitting F4. That puts the dollar signs in front and in front of the column in the row. 93%. We can drag that down because we fixed that number over here. Let's make this into a percentage. And there we go. Now the vacancy credit loss, that is taken off here. So we're going to hit equals, and we're going to click on here for the vacancy rate of 5%. And this is going to stay black because it's taken directly off that input over there. And then we're going to figure the vacancy credit loss by taking that percent and multiplying it by the gross operating income. And let's put a negative in front of it because it's going to be a negative number. It's going to go away. Okay? And I did this off the gross income because coin laundry as well. If 5% are gone, 5% less coin laundry usage. So it'll drop down that amount by $4,200, almost $4,300. And that populates by itself. And now we're going to get this important metric called the gross operating income. So this is also known as the GOI. And the GOI is the total gross income minus the vacant, or in this case, plus the vacancy credit loss because it's a negative. So $81,624, okay? Now expenses. Expenses, actually more specifically operating expenses, are what it takes to keep the building running, okay? So I'm going to copy and paste in some examples, and we'll go in a different video of how to do your due diligence on this. But let's say that these expenses are correct. And then over here, you plug in the requisite numbers. And you plug this in yourself based off your research. So, and these are all annual expenses. Okay, so let's build out the table and make it look nice. And I copied and pasted these expenses from another sheet just for expediency. Again, bam. Let's make this one closed as well. This is an important item, so we're going to do that, and we're going to make this bold. Bold, bold, bold. A few of these can also be bolded, but we'll get back to that. Okay, so we have these expenses, and again, like I was saying, well, first of all, let's add them up. So to add up this whole row, you hit equals sum, and you're just going to drag this up through here. Let's make this a negative, because this is going to be money that goes away. And you can always check market information to determine if your expenses are in line with the market. So let's do it as a ratio, as a percentage of. So you take the expense and you divide it by the total, because the total will give you the 100%. You hit F4 to lock that total so you can drag it up. You hit enter. So this is going to be 0 because there's nothing in this cell. But then you can drag this up and you should have that over there. And it's a negative because this here was negative, so we can just make it back into a positive. It doesn't really matter. And then we hit percent. Bring it out a few decimal places, and all of this should equal 100%. And what we check is we can highlight, we can look here on sum, 100%, a sum of all these percentages. So now we know, okay? We can track these through the years as well to see if there's a huge increase in a certain year or something like that. So, and finally, we get that magic number, the NOI, net operating income. Let's put a few other here. Annual debt service, ADS, and cash flow before taxes. Okay, so the net operating income is agnostic or separate from the actual mortgage, because someone may come and pay cash, and so their cash flow will be different. Someone may have a different type of mortgage, so their cash flow might be different. So the net operating income is going to be your gross operating income, and then you remove the total expenses. And since it's a negative, you just add it. So you add the negative 27,000. And that's your net operating income. And we're going to mess with this number quite a bit because it's important. Next, we're going to determine the property value off the net operating income. So the property value is the net operating income divided by the capitalization rate. So this is worth $777,000 according to this approach. The capitalization rate can change depending on the market. If it's a higher risk market, it determines that it needs a bigger return, so the value will drop. So if you're in the south side of Chicago, it might be 12%, and now it's only worth $453,000. If you're in a very stable area, it might be 5%. And now it's pushing you into the $1 million zone. But market research concluded that it's at 7% for this example. Okay, so now with this value, we're going to model a mortgage. Okay, so here we have the terms of the mortgage, basic stuff, how much your down payment is. It's 25% because the loan is 75% of the value. All that stuff. Okay, so let's do the down payment. So if it's 25%, we're going to do the difference of the loan to the value. It's going to be 1 minus whatever that is. And this is dynamic. You always want to link the cell so when something changes, it'll build out the mortgage calculator for you. Okay? So you multiply that by the property value to take 25% or whatever difference of that loan to value is, and it gives you a down payment of $194,000. So what's the loan? The loan is 75%, the other half, because the down payment and the loan amount should equal the property value or the acquisition cost, whatever you want to call it, based on your situation. So you multiply the loan to value by the property value. Let's check it. Highlight both, 77,485, we're good. Now let's model the monthly mortgage. So we do this by hitting PMT. You take the rate, so this is your mortgage rate. You divide that by 12 because there's 12 months in a year. You make 12 payments every year. The number of periods is the years times 12, which should be 360. The present value is going to be the value of the loan, the initial loan. And the future value, because it amortizes, is going to be 0, because the loan's going to get paid down to 0. And at the end of the period is the last loan. So every month, your mortgage is $3,130 at this amount. Okay? So now let's do annual debt service. We just take that, multiply it by 12. Every year, you're paying $37,000 towards the mortgage. All right. Let's change that. We hit Control 1. We're gonna make everything uniform, but I kind of want to make it more uniform now. Like, I don't like the red clashing with everything else. We'll do that towards the end, okay? So cash due at closing, we have 1.5% of the closing costs of the sale price plus the down payment. So the way we do that is we take the property value in parentheses times the closing cost. It's going to take 1.5% of the property value or acquisition, and you add in the down payment. So cash needed is $206,000. The 1.5% could be for loan origination fees, attorney costs, whatever. It could be it could be 1% based off how you do it, how you want to model it yourself. All right, and when we get that, now we know the annual debt service. So we add in right here the annual debt service. It populates there, and the cash flow before taxes is simply the net operating income with the annual debt service removed. So in this case, we add it because it's a negative. So every year, you get about almost $17,000. Now, some important ratios to have. The debt service coverage ratio is something that the lender will want to know before they give it to you. Do you have enough net operating income cushion to cover the annual debt service? And usually they want a 25% cushion. So they want a 1.25 about. And that depends on you and your lender. Okay? And the way you figure that out is you take the net operating income and you divide it. We're going to put a negative in there because we want to turn this back into a positive by the annual debt service. So let's turn that into a regular number. So that means that you have a 45% cushion in the debt service coverage ratio, that if the vacancies were to drop, for example, and the net operating income drops, you can still cover your annual debt service. You can still pay back the mortgage lender. And that's what they want. They want to get paid, okay? And then an operating expense ratio is pretty good to know. And that's your total expenses. We'll put a negative. Oops, a negative. That way it turns it into a positive number. Your expenses divided by the gross income. and we use this to benchmark, we use this to compare, and then the return of investment, or ROI, or cash on cash return. And we're going to do the first year. So that equals the cash flow before taxes. So how much cash you're actually getting versus how much cash you put in. And you put in $202,000. So let's make this a percent. Your first year, you made an 8.34% return on that money before taxes. Now let's pretty this up. So with this, we can run some scenario analysis. Let's see what modifying the net operating income does to the value of the property, and that would be by bringing the rents up to market. So I'll show you how that affects the property value. So right now, it's valued at this current NOI at 777,000. So with the toggle, we bring it up to market rents, and everything's changing. Everything's dynamic, and we can see that we just brought up the value to $841,000. So bringing it up to market rent just brought the value of the property up by 8%. Just by changing the market rent. You just got a return. Another way to do some analysis is saying, for example, like, okay, this down payment is very high, $210,000, and we know that this is a good property to buy because the debt service coverage ratio is at 1.45. But do we really want to spend $210,000 to acquire? So we get with the lender and we ask them what the minimum DSCR would be. And if they say 1.25, we use Alt A W G, and we say we're going to set sell this number here to value 1.25, and we're going to do that by changing the down payment, in a sense, the size of the loan. And this is going to iterate, changing this number until this becomes 1.25, and it's going to change the entire form or the entire spreadsheet in that sense too. Okay, so you would only need, let's keep that, 87%, so 13% down. So now you only need a payment of $110,000 to achieve that targeted debt service coverage ratio to make the lender happy, if they let you go down to such a low down payment of 13%. So those are some other ways to do some analysis on here. Another way to also bring up the value of a property is to reduce expenses. So renegotiating contracts. So let's say the property value here is $841,000, okay? Let's say we renegotiate some contracts somewhere. We'll say we're bringing this down to $2,000 and save $1,200, okay? That just brought up the property value. It's now $858. Repairs and maintenance, less repairs. Now it's $875. That has a massive effect on the value based on this model. So yeah, I really hope you guys found value in this. If you have any questions, feel free to send me a message. And finally, I like taking off all the grid lines at the end to make it a nice, clean sheet. Okay, so I took off the grid lines. If you guys want a copy of this, shoot me an email. My email is right here. And without the grid lines, it's just like a nice clean sheet. And I like that. So thanks for watching. Take care.